As one of the world's most successful investors, Warren Buffett has a long history of successful investments. Currently 90 years old, he began when he was only 11. We may therefore benefit from 79 years of financial experience. He's also encountered a series of mistakes that the typical investor makes throughout the course of his career, as well as made a lot of them himself. That is why in this video, we will unfold Warren Buffett's advice on 8 mistakes not to make as an investor. And if you haven't already, it would mean the world if you subscribe and hit the notification bell, so you'll be updated whenever we upload new videos. And hey, you can always change your mind. But with that said, let's get right into the content, shall we? Mistake number 1, not pulling the trigger on a stock. He asserts that mistakes of omission, as opposed to ones of commission, are by far the worst ones he has ever made. The things he knew he could do and were within his realm of capability, and yet he still hesitates, are the ones that hurt the most. Never do they show up any place. Additionally, it probably cost him a couple of billions to delay 20 years ago when Fannie Mae was in trouble, and Berkshire had the opportunity to buy the entire company for almost nothing. Mistake number 2, dancing in and out of stocks. And the question that is usually posed is, what should I get right now? The assumption that the news or anything else of the sort should not make you unreasonable. Now that you own stocks and parts of fantastic enterprises, you can choose the best companies in the world. And buying or selling on the basis of recent news is plain foolish. The idea that news events should prompt you to try and dance in and out of something that is a good game is a terrible error. You are in a fantastic business. You have people running it for you, and you know you're going to perform well over 5 or 10 years. Mistake number 3, buying cheap stocks of poor quality. Buffett learned this approach from Ben Graham, who advised him to compare prices and buy goods on a quantitative basis whenever possible. And that had a big effect on him. The cigar butt method of buying stocks requires going along the streets, looking for cigar butts. He then started out in quest of what he calls used cigar butts of equities. You pick up the cigar, which has only one more puff remaining but looks terrible, is damp, and smells bad. He repeatedly committed the error of doing that. Even though we might make some money from it, we can't expect to make a lot. Instead, purchasing fantastic businesses is much simpler. He no longer favors buying a fair company at an exceptional price over a fair company at an excellent price. Mistake number 4, buying airline stocks. Buffett visited US Air once and purchased preferred stock in 1989. The business went into the red as soon as his check cleared and never recovered. He claimed that it was extremely stupid and that nobody should do it. Mistake number 5, buying great stocks on a small scale. We don't do a lot, but when we get the chance to accomplish something important and properly, we must. And even carrying it out inadvertently on a small scale is almost as harmful as doing nothing at all. There won't be many great opportunities, so you need to take advantage of them as soon as they come along. It can be tempting to play around with equities, especially during bull markets. Thanks to online transactions, it is now simpler than ever. However, if you only had 20 punches on your punch card and knew that you wouldn't be receiving any more for the rest of your life, you wouldn't take your time when making investment decisions, choosing wisely and investing wisely. And you probably wouldn't even use all 20 punches in your lifetime, because you wouldn't need to. Mistake number 6, buying stocks high and selling low. Investors act pretty humanely when they get excited during bull markets and think, he made money last year, he's going to make more money this year, so this time he'll borrow, looking in the rearview mirror. And when they look back and see how much money was earned in the previous few years, they plunge in and keep pushing prices higher and higher. And when they glance in the rearview mirror and discover that no money has been generated, they just declare that this is a bad place to be and don't care what is happening. However, that creates a tremendous opportunity in the underlying business. Being human, people react in extremely strange ways. They become excited when others get excited, greedy when others get greedy, and fearful when others get fearful. And they'll keep acting in these strange ways. And in the world of securities markets, you will witness things you will never believe. Oh, and before we proceed, feel free to share your own experiences while navigating through the investment world. And which among the mistakes we've discussed so far can you relate to the most? If you're done, let's move on to mistake number 7, waiting for a market crash. If you believe you've found a great business, and by definition, a great business is one that will remain great for 30 years, you may not find the prices of a great business to be particularly offensive. So you want to support the idea of something where if you were going on a 20-year trip, you wouldn't feel bad leaving the money in with no orders with your broker, no power of attorney, or anything else, and you just go on the trip and come back and it's going to be a really strong company. He believes that if you like the company, the person approaching you, the pricing is fair, and you have a thorough understanding of the industry, it is probably best to accept the offer and not worry about how it will be priced the next day, the following week, or the following month. If stocks were quoted approximately once a year, people would make wiser investments, but that doesn't happen. Mistake number 8, following the madness of crowds. Everyone will see these enormous surges as the economy eventually prospers significantly. Additionally, if you can maintain objectivity throughout that and mentally distance yourself from the masses, you can become really wealthy. Your intelligence won't be required. Not intelligence, but disposition is required. To be able to simply sit and observe anything, you need to be able to. He began in 1950 after all, when interest rates were 2.5%. He would search through and discover things that were 2 times earnings, but totally respectable enterprises that people wanted to work for, and that everyone knew would survive. At that time, they wouldn't pay 2 times their earnings for them. The fact is, you can save a lot of money if you can keep yourself from making these typical investment mistakes. A mistake can result in a loss of 20%, 50%, or even 100% of your investment. It may take years or perhaps tens of years to rebuild. It's crucial that we resist the urge to simply follow the masses' madness, because making these errors might cost us a lot of money. We don't only wait for a crash to make sure we don't fall into panic and greed, or dance in and out of stocks. Additionally, it is always beneficial to draw lessons from the finest investors in history. Thank you for watching. I hope you gained some usable wisdom from this video. If you did, remember to hit the notification button and then subscribe to this channel. That way you'll be updated anytime we upload life-changing videos like this. Until next time, see ya!